This is a video on bond yield sensitivity, primarily focused on the concept of duration. It is brought to you by PolarisInvesting.com, a site for creating defensible valuation. Recall, business valuation is based on expectations derived from skillful consideration of past facts and future possibilities. You can access this video by going to the PolarisInvesting.com website and selecting YouTube. From the Polaris Investing YouTube channel, scroll down here to the Finance Topics playlist, and it's the video titled Bond Yield Sensitivity, or you can just click in the spreadsheet on the user guide link. To get the spreadsheet, go to the PolarisInvesting.com website, select the Dropbox link at the top. From there, make sure you're looking at the home folder and select the Finance Topics folder. From there, select the Bond Yield Sensitivity and select Download. Before discussing bond yield sensitivity, going to talk about some bond basics. And to start off with, I want to mention this quote from David Lienweber in his book Nerds on Wall Street. He said, "Stocks are stories, bonds are mathematics." An expression with a similar meaning is, stocks are like paintings, bonds are like photographs. Both stocks and bonds have cash flows generated from the return on investment and the return of investment. For stocks, cash flows consist of dividends and capital appreciation. For bonds, cash flows consist of coupons and return of face value of maturity. Bond coupons and face value are contractual. If the bond issuer defaults, the bond holder can force the sale of assets to meet contractual obligations. Stockholders have no such remedy. The high certainty of bond cash flows allows for the straightforward mathematical calculation of price. The uncertainty of stock cash flows makes the calculation of stock valuation difficult. At best, a range of valuations depending on assumptions. Let's take a more detailed look at the mathematical calculation for the price of a bond. As you can see here, the price is equal to the return on investment, which is the coupon payments, which is represented by the coupon rate R, times the face value over in years in this example, and then at the end of in years this face value is returned. So price is determined by using a yield rate I to compute the present value of this first coupon 1 year later, second coupon 2 years later, all the way out to the nth year, receiving a coupon and also getting a return of investment of the face value. Note that the face value F and the coupon rate R and the term of the bond, which is N, are all stated in the contract of the bond. I, which is the yield, is based on current market conditions. Typically, when the bond is issued, the coupon rate R is equal to the market yield I, resulting in the price equaling the face value. In the return on investment portion of the price, if you factor out the RF or coupon, you're left with a geometric progression. And when you solve that geometric progression, you see that sum is equal to this value here. But also note that you can calculate for 1 over 1 plus I to the n. It is equal to 1 minus SI. So if you plug that into the formula for the present value of the face amount, you're left with this formula down here. So you can rearrange some terms and factor out an F, and you end up with a very insightful formula for the price of a bond, which clearly shows a relationship between the coupon rate R and the current market yield I. If the market yield equals the coupon rate, then this term falls out and you get price equals the face value. If market yield increases above the coupon rate, then this term becomes negative, making the price less than the face value and is then selling at a discount. If the market yield drops below the coupon rate, this term becomes positive, making the price greater than the face value, and the bond is to be said selling at a premium. Note, you may come across bond formula using the notation A of n and Vn. Well, Vn is just what we've been calling 1 over 1 plus I to the n, and An, or annuity for n periods, is what we've been referring to as S. Now here in the duration worksheet, you can see calculation of the bond price two different ways. One is here in the table that really has each factor of the formula in a separate row. Here we have the coupon rate times the face value, which is a $4 coupon, and then what we do is we take the present value of that and then get the present value of $3.85, and then the next term is this present value factor, which is 1 plus I squared. and then a $4 coupon, and the present value is $3.70. And this is a 30-year bond, so we go down to the 30th year. You're over here, and the N is 30. Present value factor is here, and then the present value of a $4 coupon is $1.23. Face value discounted back to the same factor, $3.83. When you sum all the present values, you get a price of $100 for the bond. This is when the yield rate is equal to the coupon rate. Now the bond price is also shown here, but it's through a formula, which is the same thing as this formula we ended up with in the bond derivation. If we increase the yield rate to 5%, well, that'll cause the bond price to drop. And we can see here now it drops $84.63, and that can be clearly seen in this bond formula here, that when I is greater than R, this term here goes negative and causes the price to drop. If the yield rate goes below the coupon rate, namely 3%, then the bond price sells at a premium. A structured way to determine bond prices is often taken for granted. But up until the early 1900s, prices on bonds and stocks were primarily the result of negotiation between brokers. Brokers relied on credit ratings, their experience, and hunches to set prices. Often their hunches were highly speculative. The speculative nature of stock and bond markets in the early 1900s is astutely captured in a series of articles that first appeared in the Saturday Evening Post magazine in 1922. The articles were later turned into the book Reminiscences of a Stock Operator. The book is considered a must-read for anyone working on Wall Street. One of the most poignant passages in the book is, "No man can consistently beat the market. Human nature condemns virtually all traders." Unfortunately, primarily because of overconfidence, most readers don't think this applies to them. The articles are written in the first person as if they are memoirs of the fictional character Larry Livingston, who is based on the real life of Jesse Livermore. Livermore's life is a cautionary tale about speculation. He made a fortune by shorting stocks in the panic of 1907 and 1929. Between 1923 and 1929, stock prices increased fourfold. Indeed, it was the Roaring Twenties, the Gilded Age. At Livermore's peak, he owned several mansions, a fleet of limousines, and a massive yacht. He once made around $200 million in today's dollars on a single trade. After a series of financial setbacks, he took his own life in 1940 at the age of 63. A structured approach to pricing bonds and stocks can primarily be attributed to four people who all were born in the late 1800s, who were at the prime of their careers during the financial upheavals of the early 1900s. Irving Fisher was a Yale economist who wrote the book Theory of Interest, which formalized the time value of money and present value theory. John Burr Williams was a Harvard economist who expanded on a 1930s Barron article written by Robert Wise, resulting in the book Theory of Investment Value, which formalized discount models. Benjamin Graham was a Columbia graduate whose business night class notes were turned into the book Security Analysis, which promoted the idea of safety of principal and satisfactory returns. Frederick Macaulay, a Canadian economist with a doctorate from Columbia, worked for the National Bureau of Economic Research. In 1936, he created the concept of bond duration that quantified yield sensitivity of bonds. Here at the bottom are other people that made significant contributions to the burgeoning field of finance. Over the years, finance evolved from a branch of political philosophy to economics and eventually a separate field of study focusing on making financial decisions amid uncertainty. Now that we have discussed bond basics, the rest of this video discusses quantifying bond yield sensitivity using Frederick Macaulay's duration concept. He defined two metrics. The modified duration, aka ModD, is the most applicable metric for measuring bond yield sensitivity. It measures the estimated bond price sensitivity to a change in market yield I. Or stated another way, it shows the percent change in bond price per 1% change in market yield. The other metric is Macaulay duration, often referred to as MACD. Relative to bond yield sensitivity, it's primarily used in the derivation of ModD. When both are stated as percentages, the two metrics are fairly close in value. Thus, MACD is sometimes used as a reasonable substitute for ModD. Now direct your attention to the graph in the lower right of the worksheet. It shows how prices change with increasing yield for bonds with terms of 2, 10, and 30 years. Notice the lines are downward sloping and curved. Downward sloping means the slopes are negative. Curved means the slopes are not constant or linear. The shorter the term or higher the yield, the flatter the lines, meaning less change in price from a change in yield. As mentioned, the slope of the lines are negative since it is the norm to read from left to right. In that case, you have increasing yields. But if you read from right to left, the yields are decreasing and the slope of the lines are then viewed as positive. So whether the slope of the line is considered negative or positive depends if you're looking at increasing yields or decreasing yields. Now that we've been through the bond basics and discussed the bond price sensitivity graph, the modified duration or ModD formula should be easier to understand. ModD is the slope of the price yield line at a specific yield divided by the price at that yield. Dividing by price gives a value that is stated on a per $1 basis. The slope is calculated by taking the derivative with respect to the yield. Recall, a derivative is an instantaneous value and an exact yield. It can be thought of as a straight tangent line to the curve. As shown here in the graph, as you move further down the yield curve, the tangent line gets further away. Using the derivative as slope is a reasonable approximation of slope over a narrow range of yields. The smaller the compound period, the better the approximation because of a narrow range of yields. As the number of compound periods increases, the denominator in the ModD formula approaches 1. To better understand why the denominator approaches 1, I suggest you pause this video and review this brief summary of nominal interest rates. Since the lines in the graph decrease left to right, the derivative is negative. Macaulay decided to have the ModD always stated as a positive number, thus the minus sign in the formula. But as mentioned, viewing the lines as decreasing or increasing depends if you're looking at increasing or decreasing yields. When looking at increasing yields, you use the negative of ModD. When looking at decreasing yields, you use the positive of ModD. Next, I'm going to show the derivation of the derivative of bond price relative to a changing yield. A bond price is this formula here. Focusing on the first term in the bond price formula, you get the derivative shown here at the bottom left of the worksheet. The calculation uses the derivative chain rule. Notice the minus 1 divided by 1 plus yield term. That negative sign is offset by a negative sign in the ModD formula. This remaining portion is part of the MacD numerator. Continuing to take the derivative of each subsequent term in the bond price formula, you end up with the MacD numerator. The complete MacD is the numerator divided by the bond price, shown here. Multiplying MacD by minus 1 and dividing by 1 plus yield gives you ModD. As previously mentioned, the primary purpose of MacD and bond yield sensitivity is the derivation of ModD. It is also a reasonable substitute for ModD if stated as a percentage. An interpretation of MacD is it is the weighted average number of years from purchase when present value of cash flows are received. This means on average half of the present value of cash flows are received before and half are received after. This interpretation is not that useful for bond yield sensitivity, but it is for bond immunization. Weighted average is often misunderstood, resulting in incorrect interpretations of MacD. Weighted average is often used in calculating final course grades, where test scores are given different weights towards the final grade. Weighted average is used in calculating expected lifespan, where the number of people dying at a specific age is multiplied by the age, and the sum of all the ages times the number of people dying is divided by the total number of people to arrive at the expected lifespan. The calculation of MacD is similar to the calculation of expected lifespan. Instead of number of people, the present value of cash flows each year are used. The MacD calculation is shown here, where you can see each present value factor is in the numerator and the denominator. So when you add up the weighted cash flows, weighted by time, divided by the sum of the cash flows, you get a weighted average. As stated earlier, ModD is a good approximation for the percent change in bond price for a 1% change in yield. ModD is a good ballpark predictor of bond price changes. ModD shows that bond prices are most sensitive to yield changes when yields are small or the term of the bond is long. All right, next I'm going to use the spreadsheet to demonstrate the impact of changing yields. The spreadsheet assumes the bond is initially issued at a price equal to the face value. In other words, the coupon rate is equal to the yield. From the starting point, ModD percentage predicts a 17.29% change in price from a 1% change in yield. ModD percentage is ModD divided by 100. It scales ModD by percentage. Read F6 notes for more details. Note, since this video was originally recorded, the spreadsheet has been altered. Now the user selects either a 1% increase or decrease in yield. MACD and ModD values do not change when a change of yield is entered. MACD and ModD are predictions of how price will change from when the bond was originally issued. The prediction does not change when yield changes. When decreasing the yield by 1%, the price increases by 19.6%. When increasing the yield by 1%, the price decreases by 15.37%. The average of these price changes is 17.4%, which is very close to the ModD percentage value. Recall from the graph on the right that the derivative of the change of price relative to the change in yield is instantaneous at the current yield. The derivative is used as a constant slope for a range of yields around the current yield. This results in errors in approximation. The average of price change when yield increases by 1% and decreases by 1% is close to the ModD percentage value because the under and over errors offset each other. Okay, now returning to the original video, which shows the spreadsheet before it was altered. Okay, I'm going to go back and start over and assume that the coupon rate equals the yield rate. Now I'm going to show the impact of changing the term of the bond. If the term is lowered from 30, which has a ModD of 17.9, I change it down to 5. See here that the ModD gets lowered quite a bit, closer to the actual term itself. In fact, if I lower it all the way down to just 1, the ModD is essentially the same as the term of the bond. An ancillary topic to duration is interest rate immunization. It is discussed in the note of cell E6. Interest rate immunization makes bond prices resistant to yield changes. Take the example of needing $10,000 in 5 years. To diminish the impact of yield fluctuations, buy a 5-year zero coupon bond with a face value of $10,000, which has a MACD of 5. The zero coupon bond aligns the sources of cash flows with the use of cash flows. In general, buying a bond with similar cash flows to the use of cash flows immunizes against yield fluctuations. Immunization is achieved from the cash flows generated by the bond becoming available around the time cash flows are needed. Thus, reinvestment risk is diminished. Cash flows are characterized by MACD. Cash flows with similar MACDs align the source of cash flows with the use of cash flows. Recall, MACD is a weighted average, so MACD does not perfectly align cash flows. Thus, it does not guarantee totally eliminating the impact of yield fluctuations, but does diminish it. Another topic related to bonds is the tax consequence of bond amortization. The interest earned on a bond is typically taxed as ordinary income in the year it is received using what is known as the constant yield method. This is straightforward when the coupon rate is issued at the market yield. In this case, the amount of interest earned each year is simply the coupon rate times the face value of the bond. This is shown here in this bond amortization table. Each year, the interest earned is 4% of a $100 face value, or $4. The face value received at the end of the term of the bond is not taxed, because it is just simply the return of the original investment. When the yield is different from the coupon rate, each year's payment consists of interest and principal, which is similar to a mortgage amortization, which most people are familiar with. Let's quickly review how our mortgage is amortized. Assuming $100 is borrowed at 4% annual for 30 years, the payment each year is $5.78. The payment is constant year to year, and you notice is greater than the interest owed in a given year, so the principal is gradually reduced to zero by the end of the term of the mortgage. Now, switching back to a bond, let's change the yield to be different from the coupon rate when the bond is issued. First, the yield is lowered to 3%. Since the bond pays a higher coupon rate of 4%, it sells at a premium of $119.60, which is greater than the face value of $100. Also notice the principal portion of each payment results in reducing the outstanding balance to the face value of $100 by the end of the bond term, in contrast to a mortgage amortization, which results in an outstanding balance of $0 by the end of the term of the mortgage. Recall, when the bond is selling at a premium, it means the yield is less than the coupon rate. Thus, the interest earned is less than the coupon payment. The remaining portion of the coupon payment reduces the outstanding balance. Unlike when the yield equals the coupon rate, the amount of interest in each coupon payment is different year to year. When a bond is selling at a discount when it is issued, the yield is greater than the coupon rate. A portion greater than the coupon payment is interest that must be reported as income. A negative portion of the coupon payment goes to increasing the outstanding balance. Notice that the amortization table shows the outstanding balance in both columns Z and columns AA. Column Z's balance is calculated by subtracting the principal repaid in a year from the previous year's balance. Column AA's balance is calculated with an amortization formula shown in the notes of the cell V35. All right, I invite you to go out there and use a spreadsheet to see exactly what this price change is from a change in yield rate. Also pay attention to the ModD, see how accurate it is in predicting the price change. This has been a video on bond yield sensitivity, focusing on the bond duration metric. Thanks for watching.